Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is President and CEO of PPR Note Company, Dave Van Horn. Now, David's chief responsibilities include the oversight of the company's strategic planning, business development, and fundraising functions. His expertise is derived from over 30 years of residential and commercial real estate experience as a licensed Pennsylvania realtor, investor, title company partner, and commercial fundraiser. Now, in addition to his role as president and CEO, Dave's biggest passion is teaching others how to build and preserve wealth. Dave is a co-founder and board member of Strategic Investor Alliance, a purposeful planning and networking group for accredited investors in the Philadelphia area. Dave is also a national speaker, author, and investment blogger on biggerpockets.com. And so with that, guys, it is an honor to welcome back Dave Van Horn to the show. Dave, how you doing today?
Unbelievable. How about yourself?
Oh, yeah, fantastic. It's a beautiful day. It's a beautiful day. Life is good. Even better now that I've got you here on the show. And so always excited to catch up with you, Dave. You know, we were talking a little shop before we jumped on here, and just you've always got a lot of things going on in your business, not just a note business, but you've got a lot of different irons in the fire. Just very entrepreneurial nature to you, and so always fun to catch up and find out what's going on in your world. And so, you know, I know a lot about you, Dave, but you know, maybe those that are tuning in, you know, I've interviewed you a number of times. Again, you're well versed on biggerpockets.com. You got a wide reach, but for those that might not know who you are, Dave, take a few minutes and fill in some of the blanks of the introduction I provided for you, and tell us about who you are and ultimately how you found your way into this business.
Oh, wow. So a little bit to unpack there. First of all, when in my intro, some things that we've had some recent changes. So we've actually changed our brand, first of all. So we're no longer PPR Note Company. We're PPR Capital Management.
Okay.
So that's one change. And then another change is I've since brought on a new CEO, and I'm actually executive chairman of PPR. So I've gone on to form a board, and I brought in a guy named Steve Myers, who was formerly with SEI Investments. SEI is a publicly traded company. He was there 29 years. And to give you color, SEI had $1.3 trillion in assets under management. Don't ask me why he's willing to come to us, but the good news is he is. And, you know, he brings a lot to the table. So, for example, they had offices in Dublin, London, Luxembourg, as well as in the U.S. And they had about 3,000 to 4,000 employees. You know, we have 30. So big difference there. But it reminds me of, you know, you mentioned Bigger Pockets. It reminded me when Josh Dorkin brought in Brandon Turner. That enabled Josh to do other things. And then eventually, you know, Josh brought in Scott Trench and you know, went on from there. So it's kind of a similar story in that regard as the company's grown. You know, executive chairman means I'm staying on as, you know, I'm still there, but I'm able to do the roles that I do best. Whereas as the company grew, you know, the thing got bigger and bigger and bigger. And, you know, we're fast approaching $1 billion under management. You know, the company's really growing. And a lot of that happened in recent years, especially as we brought in more leverage. So,
yep.
So I don't know if that filled in any gaps where I started.
Yeah, well, no, and I would love to ask you a question real quick about that. Just really the, you know, you'd made mention of the, you know, the CEO that you brought in. He came from a, you know, a firm that had you know, over $1 trillion of assets under management. You know, thousands of employees to, you know, your firm, which, you know, $1 billion is definitely a significant amount, but very different than $1 trillion.
Yes.
And also thousands of employees, very different than that of 30 employees. You know, I've never been to your office, Dave, but just knowing you for some years now, and just knowing your business, I'm guessing it's probably somewhat of a family atmosphere. I mean, 30 folks, that's fairly intimate in nature. You know, again, very different than that of a international firm. And so, what was, you know, how did the acceptance with the rest of the team, how did that go, the transitionary period of getting him in there, getting him, you know, his seat, his butt in that seat, and ultimately you out of there? I mean, was there a lot of pushback, a lot of friction from the rest of the team, or were they very accepting of it? I mean, it's when you talk about like a major shakeup, that is one, right? Even though you're sticking around That's a major change.
Yeah, I mean, it can be, right? So,
Yeah.
well, years ago when I sold insurance, we'd done a little bit of financial planning, for
Hmm.
example. And I don't think, entrepreneurs or owners or even individuals, they don't plan to fail. They usually fail to plan. And I kind of knew that from that previous experience. And, there's a lot of CEOs or entrepreneurs, they have what I call the pine box exit, where they don't have an exit. They're going to carry them out in a pine box someday. Almost like TV shows, right? You'll see, various TV shows where the CEO will never step down, that kind of thing. But no, I have two really good partners. I have my sons worked there 12 years, for example.
Okay.
So it is kind of like a family, to your point, but I don't think it's prudent to run a multi-billion-dollar fund someday. It was kind of like I was the guy to take it to a certain stage, but I don't know that I was necessarily, it's definitely a self-awareness thing, and it's, you have to have some humility to go, hey, there could be a better guy to run this than me as this grows. Also, he's known to scale a business. When he started at SEI 29 years ago, 30 years ago, there was only like 100 and something employees, and it was very small. And he had a finance background. He was a CPA and an accountant. He went in at entry level, grew his way through the organization as the organization grew. So that was very appealing to me. Also, we're a big capital shop now. We raise a lot of money. I mean, our model is not real brilliant or anything. We raise money, we source deals and evaluate them, and we deploy capital, and then we manage assets or monitor them anyway, or manage them through JV partners, and then we distribute a return, and then we go back and do it again, right? It's a pretty simple model in itself, but I'll give you an example. Like, there's areas that he brings to the table that's dramatically different with the international component. The bulk of our investors are not international, for example. A lot of their investors were family offices. We literally have very few family offices. They were very big in the wealth advisory. They had a big technology platform, that kind of thing. Operations of maybe doing something in the alternative investment space with some lot of opportunity, let alone his resources network. I'm looking forward to it because I'm going to learn a lot
I bet.
from Steve. And,
Sure.
we actually share a very similar vision of, where we think we can take PPR in the future. So I think it's going to be a fun ride, actually. So I'm excited about it. Now, some people, especially like investors, they get nervous anytime there's a change. But when you think about our C-suite of our company, we had several members in their 60s, is not to do any planning. And we actually started a couple of years ago. So this wasn't like, hey, Dave's terminally ill and he's leaving or anything like, well, fingers crossed. But you get the idea. This was intentional, well thought out, planned, several years of planning. In fact, we brought in a coach to help us, Eddie Wilson, who had done a lot of M&A work. Coached us through some pieces. We hired a search firm. I mean, the process took well over a year, just interviewing candidates, finding the right people. And we had some great candidates. So no, I think we're pretty comfortable with the process, and my team was on board and involved. We're, like you said, we're a family. We're a very transparent company. We have like long-term incentive plans for our folks. All our team members are owners. That's a different model in itself too, so a little bit going on there, but yeah, I think it's exciting. And, my background was mostly real estate related. I had been a contractor for many years, got into real estate in my 20s, late 20s, started buying properties. In fact, I started buying properties with credit cards, which is probably not a good
Me
story
too.
to tell.
I bought a number of them with credit cards. Yeah, a little stressful.
So I bought probably a dozen properties that way. I would buy it with, write myself a credit card check, pay cash for a house, renovate it.
Yeah.
I was a handy guy. I could fix a lot of things. And, I was an agent, so I had access to deals. I just didn't have capital. And the capital was my credit card in the beginning. And then later on, built a portfolio. I had gotten up to about 40 units of my own. And then, I started a real estate investor group called Ring years ago. And this was pre-meetup, all that kind of stuff. And it started out with 12 people at lunch. And in about 5-6 year period, turned into 8,000 people in 5 states, 6 cities, from Baltimore to New York. And I had, like I said, 8,000 people in my database. Well, this was pre, social media stuff that you see today.
Mm-hmm.
But then, I started raising capital for commercial real estate. We were doing mobile home parks, believe it or not, in the Midwest. We were doing storage. And then we were doing some new construction, commercial office condos. So that, that's what I was doing pre-PPR. And my partner, John, when we started PPR, that's why he came to me. He knew I ran that group. He knew I raised capital. And he was like, hey, if you raise capital, I'll work the notes. And it started out as a very passive thing. I was really an investor. I was like, hey, this idea of getting cash flow without tenants is exciting. And there's no real repairs or anything, unless you took a property back or something.
Sure.
But for the most part, it was cash flow without tenants with collateral. So it was, I saw this opportunity in real estate to buy something at a discount with a high yield, with collateral. To me, that was sexy and more appealing than the traditional markets. And you see what's happening in stocks and bonds today. They had a down year in both sectors, right? So it's,
So there was a period. It sounded like that was a smaller vertical in PPR, right? Or maybe you weren't called PPR back then, but when you were buying.
No, we were PPR. Okay. But here's the funny thing: we had a short sale company, and on the front of the building was the short sale company. The short sale company went out of business, and the little note project in the back just took off and just kept going, getting legs. And in the beginning, like I said, I was an investor, and then it turned into friends and family, and then it turned into raising capital more. And then, we tested the model, made sure it worked, but then it grew into a business. And then next thing you know, I was a guy who was kind of, sort of retired, living off my cash flow and properties. And all of a sudden I'm back in a business again, which is not complaining or anything. It just shifted from me being an investor in notes to all of a sudden, up until recently, I was a CEO and president of a pretty robust, note shop, right?
So to provide some additional context here, when did the note portion of your business actually come into play? How many years back are we talking?
2007.
Okay.
Is when we started, and then it really started to take off shortly thereafter. I guess by 2009, 2010, we started. Hired a securities attorney. Like in the very beginning we didn't, and then later on we did. And then I guess it would be about 2009-ish, 2010, where it really started to get legs, almost like a syndicator would.
Sure. Sure.
Yeah.
And so obviously the distressed note market, or I guess I shouldn't say distressed, because you guys, I don't know if you do deal with just not performing or also performing as well, but either way, the world was very different. Let's put it that way. The real estate world was very different. Post 2008, 9 and 10, still lots of distress out in the marketplace. And so talk to me about how your business looked then when you guys were just starting to get legs. What were you buying? What was the focus of the note side of your company? And then how does it differ from what it looks like today?
Looks dramatically different. So you got to realize I started in real estate in 1987. So real estate's evolved quite a bit. But no, in 2007, we were actually in an up market, and we were paying a lot for a note because notes are in direct correlation to real estate values, right?
Sure.
So notes are expensive. There were times we were paying 60 cents or 70 cents. And we also started out in junior liens, and that was a lot of money for a junior lien. And you might say, well, why would you do that? Well, if it was a $50,000 first mortgage and $50,000 second mortgage, and the property's worth $200,000,
yeah,
it's not a big risk. It's just, when will you get paid?
Mm-hmm.
You're going to get compensated. So you would pay more for that type of an asset, right? Now, obviously the crash happened, and it took a lot of equity out of the market. And at first we were panicking a little bit because the portfolio we had lost equity. And in banking world, that's where banks really panic. But equity doesn't determine outcome. And that's a lesson I learned early on. And really we started working through the assets, and what we found was, regardless of equity, we would still have favorable outcomes on a large percentage of the assets, because there's what's called emotional equity, especially with junior liens. And then what we did was we grabbed all this data, and what we found, I'll give you an example. We would get out of, pre-crash, you'd get out of 9 out of 10 deals favorably. Well, even with partial equity or less equity, if a second lien if it had a first mortgage that was performing, we'd get out of a pretty high percentage of those, right? And all of a sudden you're getting out of 7 out of 10 or something. So, but you were paying a third of the price you used to pay. And that was the big difference. And then the data we collected on collections became so valuable. And that's how the company took off, where a lot of people might have packed it in or, hung up the gloves or whatever. What we found was the collection data became very valuable. And then all of a sudden we had collection data banks didn't have. And the same thing would happen with like bankruptcy assets. A bank would put all bankruptcy assets in one bucket. We determined that a third of those are just as valuable as a good asset. You just don't know which third until you start working. So that type of data, what it was is we were more in the collections business. The bank isn't. The bank's in the lending business, just like they're not in the real estate business. So I don't know that we were smarter than anybody else. We just, some of it was luck, some of it, it was similar in COVID. At first, we were like, oh, we're going to have a run on our bank. All the investors are going to want all their money back, or, how long is COVID going to last? That kind of thing. We were pretty lucky again, because what happened to us there was, even though there was a delay and a lot of moratoriums, it was almost like the virus migrated throughout the country at different periods of time, and different courthouses would open and close. What we learned was our company could work remote. It was the government that couldn't work remote. And about half of the courthouses, there's like over 3,000 counties in the US, half the courthouses aren't even online yet. That's like an infrastructure issue. Like, hello, do you think the internet's here to stay, guys? So it's, it's amazing to me that half the country is not online from a government perspective, which is a problem. But anyhow,
that is
even with the delays, though, property values kept going up.
Yeah.
And that's kind of what saved us in a big way, was even though we couldn't collect in some cases, the assets kept going up in value, which meant our assets stayed high in value. So we didn't really, we fared pretty well. We didn't miss a payment to investors, anything. I saw many a syndicator that had a pause. We were fortunate. We were able to continue paying. And we do invest in not just non-performing assets as well. We do have some performing assets we invest in, especially commercial notes we do as well. So.
Yeah, well, why don't we talk about that? Give us a snapshot of your business today. Are these senior liens, junior liens, combination of the two, performing, non-performing, just residential assets?
Yes.
You mentioned commercial there. So
yes.
Just a snapshot, if you would. That might be a big snapshot, but please help us
No.
understand the business today.
It's a good question, because when PPR first started, we were just in the junior lien business, and then later on, we were just in the first mortgage business, and we didn't have any leverage in the very beginning. It was hard to get banks to back us or anything. So as time went on, though, it evolved and it got bigger. Today, still 80 to 85% of our business, our portfolio, is still in notes and mortgages that are primarily residential. I'd say 80%-ish, and about 5 or 6% are in commercial notes. I'd say we probably run around 35 million in commercial notes, but they're usually fix and flip loans, or sometimes we'll do some 1 to 10 million commercial loans from a bank. These are performing. The commercial loans are performing, and the reason we do that is to park capital to reduce our cash drag. So we regulate a lot of capital, and a lot of times we're raising money. And you could probably relate to this if you're syndicating, commercial real estate. You know how you have to like raise money, wait till you deploy it, and you can't really start paying on it till you get some kind of cash flow going.
Yep.
And sometimes in a value add deal, you have to wait a while, before you can, because you're renovating so much or something. Well, with us, a lot of, especially the performing notes, we can use that to regulate capital while we're raising, so that we can pay on the capital from an earlier time period. Our investors don't have to wait long. And the beauty of that is we'll invest in fix and flip loans, and we'll invest in, some bridge, and not so much today, but The market's changed a little bit. So our strategies now are much different than a year or two ago. But we'll invest in these commercial notes and they're cash flowing. And the beauty of that is we don't have cash drag while we're waiting to go make the next, whether it's a multifamily acquisition or whether it's a trade of mortgages, a pool of mortgages that we're going to buy. We don't have the cash drag while we're saving up the money to go make a big acquisition, if that makes sense. So it's that vertical is very, years ago we didn't have that. We were more of a one-trick pony back in the day. Today we have a lot more flexibility, and we can recapitalize in like 3 different ways. We can put those performing, fix and flip loans on our line of credit we have and recapitalize right away. We can sell them on the secondary market up in New York. And then the other one is we can even lump it into a securitization if we have one going on at the time. So, we have a JV partner on the West Coast that works a lot of the NPL business that we do, non-performing loans. They have a trade desk in New York, so that gives us a lot more flexibility to acquire, more product, better deals. And then we also get some institutional leverage. So we'll take the private equity we raise, marry it to some institutional capital, go out and make, trades on non-performing loans. And what we do is they have a team that works those loans. Years ago, we used to do all that. We do very little asset management in-house. We do some couple key verticals that we still like, but they do the majority of it. And what they do is they'll make trades over time. So it's almost like kind of like dollar cost averaging, where they go out and they make trades, and then they aggregate these pools of mortgages till they get to a critical mass. And usually it's around the 200 million mark. And then once we get to greater than 200 million in assets, then we can go securitize.
Got it.
And that's usually, most of these arrangements we make with them are about a 3-year period. It's like 33 to 36 months. Well, around month 15, 15 to 18 months, you aggregate enough assets to where you can take it to securitization. And that's just a fancy word to say you're refinancing a pool of mortgages. And you're actually de-risking everything and usually getting into more favorable interest rate terms, although now rates are kind of high. I'm not going to deny that. But you de-risk the portfolio, and then you wind down the rest of that portfolio. And then you go over the remaining 33 to 36 months, and then you turn around and do it again. And that's pretty much what we do with this. We have a JV partner in Orange County, and they have, under 100 people there. And they do what we used to do. So it's not like we don't know what they're doing. We used to do what they do. So it's they just happen to have a more efficient machine. And it makes more sense for us to, especially scaling, to outsource it to them. If we tried to do everything ourselves, PPR would have 130 employees instead of 30.
Yep.
If that makes sense.
Yeah, I'm sure there's a lot of moving parts in the non-performing loan side of things. Correct? I mean, as far as the overall.
Oh yeah, I mean, their REO department's probably 25, 30 people just in their REO department. I have one. I have a couple. I have one main REO girl and a couple other. You know what I mean? So it's they're definitely more built out than we are in a lot of areas. Our servicers also nearby, and we have a good relationship with them. So it's you have more clout, right? Just like with capital too, they have better sources and terms on, from the big shops in New York to get better, terms and pricing on capital and things like that. So no, it's been a great arrangement with them. So we do benefit from that. And then, I kind of talked to you about the commercial stuff to regulate capital. And then the remaining 15 to 18% of the portfolio is in commercial real estate. And what's happened over the years was, as we grew in volume in the NPL book of business and things like that, you become more profitable, but there's not a lot of tax advantages. Well, the commercial real estate has a lot more tax advantages. And then, so a lot of it is, related to tax strategies and things like that of why we do commercial. And a lot of folks don't know that, previous to PPR, I was in, I raised capital for commercial real estate, which ironically was mobile home parks, storage centers, and some commercial development. And in a previous life, I was a contractor as well. So it wasn't like I had never done property management. I had done all these things as an agent and as a contractor and as a landlord. I, had 40 places of my own, and, rented them all out. And then I managed some for other people too. So it wasn't, it's not that strange that I'm reverting back into commercial real estate world. When I got diverted into the note business, so to speak.
No, you're well versed. In fact, I mean, even though I've talked to you many times in the past, I didn't know some of that background of yours either. So anyway, you're incredibly well versed in the real estate world, that's for sure, from construction to property management to notes to development. it's great.
Yeah,
It's
no, I built
fantastic.
some things, not a lot. I mean, I built some stuff though. I built some commercial garages on one of my properties. I had
Mhm.
built a big case, different things. But when you're a contractor, it takes, especially in residential, it might take 25, 30 subs to build a house. I was one of those contractors, right? And I could read blueprints and estimate. And, my son still does that today. In fact, our company's 31 years now. Our company's been around, which is another business that I had started previous to PPR. So it's, just one of those things. I have one son that works in my old business and one son that works in the current business. Believe it or not, none of that was planned. It was just kind of, in fact, they both went off and worked elsewhere and then came back, kind of thing.
That's great. Yeah, no, fantastic. So, I'm curious to know, I know that you guys don't have the vertical in-house, but you guys are still, technically partnered, in the non-performing loan side of things. And, has there been any major uptick of fallout or defaults as a result of the pandemic, or, as we come out of these last couple of years of lots of deferred payments, now there's lots of larger employers, more specific tech companies now that are doing layoffs and things of that nature. I mean, have we seen any shrapnel come out of the pandemic at present, or do we anticipate any shrapnel in the note space over the next couple of years, meaning more non-performing notes or more defaults?
Well, you're hitting around it, right? Usually, we're a type of fund, especially post-recession, we're a fund that takes off because the number one economic indicator for the NPL, non-performing loan business, is unemployment. Because there's four main reasons people default: death, divorce, job loss, and medical. And job loss is the one that tends to be the big variable. So if you notice back in the crash in 07, 08, 09, unemployment was very high. Well, that's when, and real estate, interest rates were coming down, right? We're in a much different market now. There's a lot more equity in the market right now. Back in like 07, 08, the number of adjustable rate mortgages was huge. It was like 25 or 30% of all mortgages were adjustable rate, or they were there was a lot of second mortgages at the time. Today, there's very few junior liens and there's very few adjustable rate mortgages. Now, there might start to be more adjustable rate mortgages being written right now because rates are higher. But you could see that you go through these cycles, and we're in a high rate environment. But back then, usually, like you said, the big thing is unemployment. So the question right now, what's kind of unusual is that you have a technical recession where GDP was, down for a while, but unemployment was still really low, right? Which is it's just an abnormal state of affairs kind of thing. So is it a true recession if unemployment's not high? And that's what everybody's saying. It's a structural or technical or whatever they're saying, right? It's because they're trying to get their arms around the fact, are we really in a recession? And a lot of it's coming from COVID, whether it was, supply chain issues or labor issues. Certain sectors, they're still having trouble getting labor, or but usually if there's a lot of layoffs, somebody eventually will lose their home, and that's really where, and unfortunately, that's where non-performing loan prices get cheaper and more abundant. But we are seeing some shake up in the credit markets. So it's coming from the commercial side with the interest rate hikes. So I think we're going to see a lot of opportunities. We're already seeing a lot more trading. And I think you're going to start seeing the prices adjusting and getting cheaper in the NPL world. And that's what we're gearing up for right now. And we also think we're going to see it in the multifamily side. I think that, not saying I'm right or not, but my view is that a lot more of the deals are not necessarily going to come from our operators and JV partners as they will from the finance sector. I think a lot of the deals are going to come from there were a lot of bridge loans being written over the last couple of years. And now you're getting to a point where, these things are adjusting or the time period's up,
Yep.
whether they were in a 3 or 5 year, bridge or whatever they were in. And now that it's time to pay the piper. Also, cap rates are higher. So when they did their forecast years ago, their pro forma, and then now all of a sudden they're not able to get as much money when they go to sell. Then they go, well, if I go to refinance, the terms are lousy. And then if I keep it, there's issues with my rate cap and their debt service cover ratios and all that, which will impact their cash flows, right? So some of these guys are going to find themselves in a box, I think. And I think that's going to create a lot of opportunity for us. Not that we're wishing anything bad on anybody, but that's where I think we can come in as a fund and help out, because we're capital, right? We can come in and find ways to make hay.
No, I agree.
Sunshine, so to speak. But I don't know that that'll go on for a long period of time. It might only be through 23 or part of 24 or something. I think eventually the market will be probably fine, but we're probably going to go through a period like that, I think.
So have you proactively taken steps inside the business to prepare for maybe some of those opportunities that might come our way? More specific to the commercial side, right? To some of the bridge notes and those different assets that might struggle given rate cap or the rate cap environment. They can't get another rate cap, or it's too expensive, or ultimately that bridge came to maturity. DSCR is prohibitive for refinancing. They can't do that. And even on the sales side, right, as you'd mentioned, cap rates have expanded a decent amount, and ultimately they might find themselves in a very precarious state. And so, have you guys proactively done anything internally to get yourselves prepared for that?
Oh yeah, I mean, we have a whole commercial real estate division. We have a portfolio manager. We actually have an economist on staff, and we come up. He's actually a market watch forecaster. So we get real-time economic data regularly. And then what we do is we develop an allocation thesis for the year, and then we adjust it quarterly of where we put our capital, how much in what vertical, that type of thing. And then there's when we say we invest in multifamily, it's a very narrow area where we invest. And there's certain ways we invest as well. So it's not, I don't want people to misunderstand what we're doing, because a lot of times people say, well, if you're investing in multifamily during this market, you're crazy. Or if you're investing in this market, why are you doing that? But what they don't understand is what we're doing is very strategic and intentional.
Yep.
And it's only in very finite sectors for very specific reasons. So I don't know if I could say that clear enough.
Yeah,
but when I look at our strategies
why don't we talk
for the whole company,
I'd love to chat about that, Dave.
I'd
love to chat about that. I mean, what are you up to today? Because I know that you've got a number of projects going on outside the actual note business itself. So maybe that way there's no confusion. Just offer some clarity as to some of the projects that you're currently working on.
Yeah, I mean, sure. I mean, let's take multifamily, for example. A couple of years ago, we may have been a similar regular multifamily value add type investor. We're typically in the C+ to B+ space. We're always looking for best in class operators, super experienced. We're very similar to a lot of other funds. We love the Sun Belt. We'll do some other tertiary markets. Our model is to be able to deploy some capital with multiple operators in multiple MSAs, in high growth areas, sound familiar to a lot of folks. And we're typically in a C+ to B+ of underperforming assets. We do like the value add, that type of thing. So it's not like we don't like that type of product. We do in a normal market. We do like best in class operators. I mean, I'll be honest with you, we're very strict in our vetting, and we screen the operator. I don't want to say more than the deal, but in a way it is more than the deal. We won't even look at someone's deals until they're vetted as an operator. And we're really looking at operators who've been through a long history cycles who, think about it. Who do you want to be in a foxhole with when the going gets tough, right? It's kind of like that. And we're managing other people's capital. So it's not so much, Dave Anhorn can just raise money and go do whatever he wants with it. Like I said, we have an investment committee, we have an allocation thesis, we have an economist that backs up a lot of that. So, we're developing some proprietary software, for example. I mean, they even go down to, how you'll do economic growth and population. We're going down to the zip code level. Like we're going, we go way beyond what normal folks would probably do. So that being said, we're not only vetting deals, and that's the other thing, we're not really looking for deals. We're looking for operators.
Yeah.
So our whole model is completely different than typical multi-family person. But in this market, a lot of things have shifted. So now we're looking for opportunities in distress. Why? Because we've been in the distress business since the beginning of time. That's what we do, right? The other piece is we are definitely very bullish on, tax advantage situations. And I'll give you an example. We like the affordable housing space. And there's big shortages of it all over the US. In fact, almost all 50 states have shortages of affordable housing. And when you think of the top high growth states, whether it's California or Texas or Florida, they just don't have enough affordable housing.
Right.
And there's a lot of advantages tax-wise to doing that, whether it's LIHTC credits. So if you're in a LIHTC credit situation, the value of the project is not so much the value of the rents and the cash flow. It's a lot of it's about the ability to sell off these tax credits to a corporate sponsor on the exit. So we're doing a couple of development deals right now in affordable. And what we like about that is we're in and out in 2 years. It's almost like we're the bridge financing to develop the project. And once it's developed, we're selling it off. We can make a very good return in a very short period of time. And what that does for us as a fund is it reduces our market risk and interest rate risk, which is what everybody's experiencing right now. So that's what I mean by shifting strategy to do things differently. Now you could say, well, why wouldn't you hold on to that? Well, if I did, we're taking on all the risk, right? So now why would someone want to buy that? They have a different motive. They need the tax credits for other reasons, right? So that's what makes that valuable. Now, not all of them have LIHTC credits. Some of them have, we have one project, it's an opportunity zone, and then there's, tax abatement. Also, what we find is some municipalities and cities, like we're working on one project, it wasn't really zoned for that. So they're allowing this type of zoning, and they're actually allowing us to build double the number of units than you normally would have been able to do. Because most people would go, well, it's affordable housing. How can you make that work? What they don't realize is there's such a shortage of it that you get more government involvement that is more willing to bend over backwards to help you get that project through. And they'll actually give you, some enhancements that you normally wouldn't get, right? So that's why I always, with an asterisk say, yeah, we're doing multifamily, but it's much different than what people's normal view is probably of some of those projects. You know what I mean? So it's a totally different approach. And then a lot of times there's also a nonprofit component. We have a nonprofit arm where we get access to government assets, government agency debt. It's a similar strategy on this side where we work with a nonprofit in the affordable housing space. So not only can you do a good for the community, you're able to, do something pretty good for the investors too, even though it's a market that's not normally, conducive to all this, right? So it's like, and we did the same thing in the non-performing loan space. We shifted gears dramatically in the way we were buying. In fact, there were a couple of quarters we pretty much, we were pausing a little bit, and we weren't taking down as much volume as we normally did till the pricing adjusted, because it was kind of like catching a falling knife. Well, we know that from experience. We're just patient investors and wait a little bit, it'll catch up, and then we can go back in and buy better. So you just have to be, aware of when to shift gears. And I think experience tells you that more than anything. Yeah. If you're someone, I look at my sons, right? They're like, yeah, these interest rates are really getting high. Well, I go, they're not that high yet.
Yeah,
trust me.
You don't even know.
When I started in real estate, they were 14. So you're okay. We'll get through this. But no, but they're just not used to dealing with it because rates were so low for so long. And, you're spoiled with cheap money, basically, for such a long period of time.
I remember when I bought my first primary residence, I bought a couple investments before I bought the first primary, but I was so excited to get, it was 8% 30-year fixed. And I was just, I was elated. It was fantastic.
No, I mean, there was a time when, in fact, my partner, John, was my lender years ago. And one of the last rental properties I had bought was 2006. and my interest rate was 8%, and it was on a rental property. And if you think about it, we just hit that period again. There were rental loans that were bordering on that 7-8% range, right? So very similar to back in that time period, when that took place. But
I'd be interested to see, and maybe it's such a micro size piece of the overall note space, but I feel that over the last couple of years, the short-term rental sector in certain markets became oversaturated. Also, I think that some of the loan programs that I've seen out there have been fairly risky structures, and I've seen a little bit of pullback in the short-term rental space as far as oversaturated markets. They're not getting as many bookings. Just the data supports that. Maybe during COVID, folks were doing staycations. They weren't they weren't taking planes. They weren't traveling internationally. That has now shifted, right? We're not necessarily just driving 3 hours away from our house and staying in a cabin, whereas that's what a lot of vacations look like during the COVID period. So have you guys seen any data to support that, default, uptick in those types of loans?
Well, I mean, banks are reluctant to lend on short-term rentals, right? Isn't it a little bit different where correct me if I'm wrong, I'm not really, other than staying in short-term rentals, I don't really know much about the financing of them.
Yeah,
I
fair
do
enough.
know that a lot of the, all the major cities have cracked down on it. I know, for example, like right now I'm in Texas, and I know San Antonio has this interesting rule where you can't have more than, I don't know if it was 12%. It was some percentage within a certain block area. They would only issue so many licenses, and otherwise they would shut it down, kind of thing.
Yeah.
So if you're like first in, you did okay, but if you weren't, now you were either going to a midterm rental or a long-term rental situation.
Yep.
So it definitely changes the dynamic. And same way with if you had an apartment complex and you were like hoping to have one building or two buildings to be short-term rentals, it might be easier in that case. But yeah, no, it's I don't know what the financing. It reminds me of I don't say it's as bad as the marijuana situation where banking wouldn't come along. But it's kind of similar in that regard where, banks just can't get their mind around short-term rentals, even though some people have been doing it very well for a very long period of time and have a great track record. It is kind of funny where I think there's an opportunity there for banking and capital to get involved. And if you think, even with some of the things we're doing, if you think about it, banking, Wall Street, it's all ripe for disruption right now. Real estate, insurance, they're all ripe for disruption. And a lot of it's coming from the Jobs Act and being able to, go out and syndicate. Years ago when I started in real estate, the average guy couldn't go start a syndicate. Like, you didn't.
I mean,
hear
unless
about
you had
stuff like that.
unless you had a wealthy network, unless you're part of the country club and
Yeah.
just part of that good old boys network, and or surrounded by very high net worth individuals. It just, if you didn't know, you didn't know before the Jobs Act was passed. I mean, the interesting thing is that you and I being in this world, and we see it every day, and so to us it seems like there's just a lot of syndicators out there, but we're really just in the infancy stages of this. I mean, really,
Yeah.
when you think about it in the grand scheme. And so I think there's still going to be a lot of opportunity. I think there's going to be a lot of growth in the space. And I also think the good thing is I think it will ultimately over time will weed out some of those groups that are, that ultimately are, maybe not as skilled as those that have been around the block for a couple of decades. And so, but again, definitely still in the infancy stages of the syndication world. And it's very exciting, very exciting. I mean, if you went and lined up 10 people in your neighborhood that, that did well for themselves, maybe they were, they met the accreditation status. And if they didn't know you, Dave, you just picked 10 random people, they all had $1 million net worth or, an income that supported them to be accredited. My guess is that probably at least 70% of them would have no idea about this alternative investment world that is even available to them. Would you agree with
No,
that?
that's true. I mean,
And maybe even 80% of them. I mean, like it'd be a large number, a large contingent of those random 10 people would not know that this world even exists.
No, I think you're dead on. I mean, the majority of people, especially if they're high income earners or even entrepreneurs, a lot of them are, going to a wealth advisor, S&P 500 type thing, index funds, things like that. They're just not well versed in alternatives. And I don't know that it's their fault necessarily. It's
Oh,
just they don't have the time to go learn a whole new industry, and trust it enough to be able to do it. Most of the time, we're considered like an alternative investment, where a typical wealth advisor would say to a client, "Oh yeah, you can invest, 10% and swing the bat at that crazy alternative, mobile homes that you're thinking about doing."
yeah.
Um, Now, me personally, what I do is much different. Like PBR is super conservative. Me, I'm not. My strategy on a personal level is pretty simple. It's really short term, midterm, long term, tax advantage, non tax advantage,
Hmm.
and then I invest in what I know, which is mostly real estate related, lending related,
Yes.
maybe a little bit insurance related. But it's because I have experience there, was licensed there, and I like asset backed investments most of the time. I do have some other outliers, but
Yeah. Well, Dave, it's always fun, always exciting to bring you back on the show here. And I guess again, those that don't know of you and would like to learn more about PPR and all the different verticals that you guys have and everything that you've got going on, where's the best place to find you?
PPRcapitalmanagement.com, which is spelled a little different. The capital everybody knows how to spell, but it's MGMT.com.
Okay.
But you can find more about us, our strategy, how to invest. We're always looking for additional investors as well. And I think for us, we're real estate investing simplified is probably the easiest explanation. I think people come to us for a coupon payment. We
Hmm.
ACH monthly. We've been doing it for 15 years. We have a long track record. We're super diversified. 80% of our book of business is 1 to 4 family residential mortgages all throughout the country, right?
Hmm.
So someone coming into that fund is just invested in a lot of markets right away, right? If you think about it.
Yep.
And then on the commercial side, that's kind of growing. But like I said, we're looking for best in class, major MSAs, mostly Sun Belt, some tertiary markets. So you can see where the thesis is. And then we regulate capital. And I don't know that we're trying to deviate a whole lot from some of that. I'm not saying we would never, invest in something else. Sure, for us, something else would be like storage, for example, or even mobile home parks, maybe. But one of the things I like about storage these days is it's recession resistant. A lot of it is mom and pops, and a lot of times it comes with seller financing, and in a tough financing market, that could be advantageous, right? So
Hmm.
there's certain sectors, just from experience, there's certain times that they make sense more than other times, right?
Yep.
And I think it's just I don't believe someone should be willy-nilly and just go invest in a bunch of, stuff like that. I think we're very intentional and very strategic.
Hmm.
Just like when we say we like B class value add, up until recent years, the reason we like that is because there's a structural housing shortage per our economist.
That's right.
They're short this many million units. There's nowhere to go, right? So you can't build it for the cost that you could buy existing. There's a lot of factors, right? We're looking at a lot of stuff. We're not just going, hey, we like B class because we picked that, not, we like that number, or that letter or something. There's a lot that goes into why we pick certain classes of what we look at where, and I'm sure you do the same thing when you're doing your
Absolutely.
diligence.
Yeah, no, absolutely. And again, I think just to the point of there's a litany of ways to make money in real estate, guys, just what we're speaking about, the strategy, Dave's strategy, which he's honed over many decades. That's surely a way. What we do is different than what Dave does. It doesn't mean that one's better than the other. There again, there's surely a lot of different ways to make money, and there's a lot of asset classes that are absolutely phenomenal. Speaking to mobile home parks and self-storage, while our company doesn't invest in self-storage, I've got a lot of personal capital in self-storage investments. I absolutely love
Yeah.
that vertical. Love that space, a medical office, multifamily. There's a litany of others that are just phenomenal asset classes and do really well during recessionary periods of time. And so I think it's just, finding your lane, or if you're that busy individual, the individual that's a, high income earner, high net worth, but just doesn't have the time to, personally invest their time, energy, and effort into doing deals, then you find a company like Dave's or like ours that ultimately do the work for you. Basically, we do all the hard work behind the scenes. So,
Yeah, I mean, right now, I mean, we pay, pretty high returns, right? And we even have a UBIT blocker fund, right? So if somebody wants to come from
oh,
a
interesting.
qualified plan and not have
Okay.
any tax implications. So I think there's a place for us in someone's portfolio. We're not wealth managers. We're not like trying to manage everybody's, Kevin, give us all your money. We want to manage it for you. We're actually the opposite. We don't think you should give us all your money. We
Exactly.
think you should spread your love around, and hopefully you do well with other operators as well. And I'm the same way. I'm kind of in that theory. I think there's a place for certain things in
Mm-hmm.
people's portfolios, and over time we've done pretty well improving it. And it's exciting right now. So we're in a exciting growth period, I think.
Well, I'm excited for you. Yeah, no, I'm
Lots of
excited.
opportunities.
I'm excited for all these, the future opportunities that you've got. You've got some free time now. Well, not really. You already occupied the free time that you created by bringing the new CEO in, but excited to chat with you again in the future and learn about some of these different opportunities that you're working on and projects, and just excited for that next phase of your journey.
No, I appreciate you having me on. Thanks, Kevin.
Alrighty, Dave, you take care. And guys, that's all we have for this next week's show. And so until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.